So, are we in a massive financial bubble? I mean, it's the question on every investor's mind, right? We've got a legendary figure out there sounding the alarm. But what if the real bubble isn't where everyone thinks it is? Let's get into it.
Yeah, we're talking about Michael Burry. You know him from The Big Short, the guy who famously called the 2008 financial crisis. So when he talks, people tend to listen. And right now, he is warning that we are just surrounded by speculative bubbles that are all about to pop.
Okay, so here's the plan. We're going to start with Burry's warning, then we're going to flip the whole thing on its head and ask, where is the real bubble? After that, we'll look at Bitcoin and the S&P 500 in a totally new way, and finally, we'll talk about what you should be looking for next.
All right, first up, let's really dig into what Burry is saying. See, he isn't just shouting that things are overpriced. Nope, he's drawing this very specific, really dramatic parallel to one of the most famous bubbles in all of history. He's got two main targets in his sights. First, the S&P 500. He thinks that's a classic bubble just waiting to burst. But oh man, he saves his most colorful comparison for Bitcoin. He's actually liking it to, wait for it, the Dutch tulip mania. Yeah, one of the most infamous financial manias ever.
So, what exactly was the tulip mania? Well, back in the 1630s, in the Netherlands, these rare tulip bulbs became the ultimate status symbol. I'm talking the thing to have. Demand just exploded. Futures markets popped up out of nowhere and prices went to absolutely absurd levels. Get this. At the peak, a single bulb could cost more than a house. And then, the bubble burst. At a totally normal auction, nobody showed up to buy. Just crickets. Panic set in, and the whole market just imploded. Burry sees that exact same kind of irrational hype in today's assets.
Okay, hang on. This is where we're going to pivot. Burry's comparison is powerful for sure. But what if? What if he's pointing his flashlight in the completely wrong direction?
You really have to ask yourself, does that historical parallel, does it really fit? Is it possible there's a different, maybe much larger bubble that we're all missing? One that's just hiding in plain sight?
Okay, this right here, this chart reframes the entire debate. I want you to forget about stocks, forget about crypto, just for a second. Look at this. This shows the purchasing power of $100 over time. Back in 1913, your $100 was worth, well, $100. By 1971, it's worth about 20, and today, it's worth less than $3. Now that looks like a bubble that's been slowly, but surely, bursting for over a century. And to really get this, we need to be crystal clear on what we're talking about. It's called fiat currency. Basically, it's money, like the US dollar, that only has value because the government says it does. It's not backed by anything physical, like gold or silver. It's based on trust.
So, what happened? What made its value fall off a cliff like that? You can point to one specific year, 1971. That's the year the US officially cut the dollar's last tie to gold. That one decision completely untethered money from any physical anchor, and it allowed for the constant printing and, devaluing of currency ever since.
So, let's bring it back to Bitcoin. How does this new perspective, this idea of a fiat currency bubble, change how we see it? Well, all of a sudden, Michael Burry's main target starts to look completely different.
And this slide just lays out the two competing stories perfectly. You've got Burry's view. Bitcoin is just a modern-day tulip bulb, a speculative asset with no real value. But then you have the counter-argument from folks like José Luis Cava. They say, no, Bitcoin is acting more like digital gold. It's a potential safe haven for capital that's trying to escape the slow-motion collapse of fiat money.
And let's be real, the Bitcoin market today is a completely different beast than it was in the early days. This isn't just for tech enthusiasts and early adopters anymore. We are now seeing huge, massive institutional demand coming in through these new spot ETFs. These are basically just traditional investment funds that buy and hold actual Bitcoin. And this flood of big money, it's fundamentally changing the whole game.
All right, so that's Bitcoin. But what about the other target, the S&P 500? Burry sees a bubble there too. But again, just like with Bitcoin, the reason for its incredible rise might not be what you think it is.
The argument goes like this. The stock market hitting all these record highs isn't just because everyone's excited about AI. No, it's what's being called a liquidity bubble. And that just means it's being inflated by a simple, massive tidal wave of cash that's just looking for somewhere to go. So here's the mechanics of it. Step 1. Central banks all over the world pump enormous amounts of cash into the financial system. Step 2.
All that capital starts looking for a safe place to go that can also give it some returns. A lot of it ends up in the US market. And here's the kicker, step 3. A huge chunk of that money gets poured into passive S&P 500 index funds. These funds automatically buy shares in all the companies in the index, pushing prices up across the board, whether the companies are doing well or not. No one is even looking at the balance sheets.
And the scale of this is, well, it's kind of mind-boggling. We're talking about roughly 55% of all investment now flowing through these passive funds. Just let that sink in for a second. More than half the money coming into the market is on complete autopilot, buying stocks whether they're good, bad, or just plain mediocre. And it's inflating the entire index.
So, okay, if the real bubble is actually cash, and the markets are being driven by this massive river of liquidity, where do we go from here? What happens next?
Well, in the short term, it looks like that river of money is going to keep flowing. The general consensus is that all this liquidity from central banks and governments will keep propping up asset prices, maybe even pushing markets higher into early 2026. For now, it seems like the engine just keeps on running.
Okay, let's wrap this up and pull it all together. What are the key takeaways here? First, the biggest, longest-running bubble might not be in stocks or crypto at all. It might just be the cash sitting in our wallets. Second, this completely reframes assets like Bitcoin, right? They start to look more like a potential hedge against that currency decay. And third, the stock market, it's being powered by this huge automated flow of capital that might be even more important than how any single company is actually performing.
And all of this leaves us with one last, really crucial question to think about. If the cash in your pocket is basically designed to lose value over time,